Hello, can everyone hear me? Can all of you hear me? Sahid, Tanubir, Muhammad, Akshita, Dinin, Rezi. Can all of you hear? Okay. Sorry for being late by 5 minutes because my net was creating a problem. There was some net issue. So that's why I logged in late. So today we have insurance class, isn't it? Alright. So now, let's just start. Today's class for insurance. So sir is not able to take the class today. There is some problem. So I will be conducting the class. Okay? Is that fine, everybody? Alright. So we in the previous classes, I think you have been taught what is insurance, what is the purpose of insurance, and all the details. The types of insurance, life insurance, that has been covered, isn't it? So now today we are going to discuss about life insurance a little bit in detail, more in detail of it, and why do we need life insurance, what is the purpose, why is insurance so much stressed upon that. Okay? Alright, so today it must be off for everybody, isn't it? A holiday in any. Now let us just start. So can you just see what's written here? Everybody, I'll just adjust the screen resolution. Yeah, now can everybody see? Weekend started. So Thursday and Fridays are fun days for you, isn't it? So anybody planning to go for a movie this Saturday, Sunday, this Thursday, Friday? Okay, so everybody, you can just see what's written on the screen. It says, Mr. Mehta was very happy with his job, his family and his life in general. He was very particular with his finances. His 8-year-old daughter and 9-year-old son were doing well in one of the best schools in India, and his wife had the financial comfort she wanted. However, Mr. Mehta will conquer that one can never tell when fate will tarnish a pretty picture. Yes, we never know what future has in store for us. He suddenly suffered a heart attack with a few complications and was admitted to the hospital. 3 weeks in the ICU, and an angiography and angioplasty struck him with a serious financial blow. Obviously, treatment in hospital is a pretty expensive affair, and that too a cardiac issue. It's too much of money. His modest medical insurance covered some of his expenses, but he had to dip into his savings for the rest. He thought his current financial plan was solid, but he was wrong. What if the next time his medical expenses are even higher? What about the money he has to keep aside for his daughter's wedding or his son's higher study? Means because of this problem that struck upon him, all his financial resources were exhausted. Okay, everybody? Everybody following? Is everybody listening? Tanubar, Seher, Rezi, Muhammad, Akshita, Rinin, Rezi is answering. Okay. So, what if he doesn't pull through the next time? Who will take care of his family and support them financially? Another disaster like this will destroy his long-term savings plan. So this was it. He had to reassess his financial structure. Statistics showed him that if he saved a little money every month in a life insurance policy, he would be in an even better position to deal with any unforeseen setbacks in the future. His family will have financial security if he isn't lucky enough to survive the next time. Yes, this was a very prominent question which was playing on his mind. What if he doesn't pull through next time? If he won't make it next time, then what is going to happen? Just a second. He also decided to take into consideration the expenses for his children's higher studies and marriage. Mr. Mehta was thinking very clearly in the long term now. Now his picture was a long term picture. Now no more short term plans. Although we don't want to think of these situations, but preparing for them with the right financial planning will only help our long term goals. So Mr. Mehta realized that this the hard way. Luckily, we have the chance to learn from his mistake and better prepare ourselves from now for an uncertain future. Yes, Mr. Mehta, he suffered a lot because of his, we can say, little bit of carelessness. He didn't thought of this problem any time at any point of his life. But when he faced it, he realized that really financial planning is important and life insurance is very important. So now, what happens next? So this is what happens next. I'll just adjust the resolution. Can everybody see now properly? Is it readable? Is it readable, everyone? Everyone can read properly? Okay, I'll adjust that. Now, okay, so now you can read. When Mr. Mehta decided to get life insurance to protect himself and his family, he had to be sure he was choosing the right policy. He had to buy a life insurance policy that caters to his needs as well as his son's education needs and daughter's marriage expenses. Means these are the general things which we keep in mind when we go for some kind of financial planning. What our future expenses will be and how are we going to meet that. That was all that was playing in mind of Mr. Mehta. He was clear about that. These decisions could not be taken lightly anymore. When he was faced with his own mortality, it gave him the push he needed to save wisely and save for the future. So his life insurance company helped him derive a formula that best suited his requirements and the requirements he has for his children. So various life insurance policies he could choose from are listed below. These are just a name of the policies from which plans which he can choose from. They are the policies, they are not actually the plan. Plans are, means you say cold drink. So cold drink is the policy. Whether you choose Pepsi, Cola, Sprite, Maaza, Thumbs Up, anything, that is your plan. That is the plan, product. Okay. So term insurance policy. Term insurance means a long-term policy, as the name suggests. So it's a contract between the insured and the life insurance company to pay the person or persons he has given entitlement to receive the money in case of his or her death after a certain period of time. So these policies can be taken for 5, 10, 15, 20 or 30 years. Okay. So you receive money at the end of death of the person. Now endowment policy. In an endowment policy, periodic premiums are received by the insured person and a lump sum is received either on the death of the insured or once the policy expires, whichever occurs earlier, either the death or the maturity of the policy. So there was this term insurance has got a big disadvantage. If a person dies, like if you take a policy for 5 years, you continuously pay your premiums for 5 years, and then that policy, the premium payment comes to an end, and then you die after 25 years, then you will get money at the end of 25 years. You will not get the money immediately. So To avoid this, an endowment policy has been created. And what if you get money after 25 years of debt? Suppose your payment of premium stops in 2015 and you die in 2030. So after 15 years you are going to get the money. So what is the problem? We can wait for 15 years. Is there any problem in waiting? Is there any problem in waiting? What do you think? Is it like feasible to wait for 15 years to get the money, or is it just fine? No. Why, Rezi? Why do you think it's not feasible to wait? Sahir, Sanubir, Muhammad, Akshita, Rindin. Why is it not really a good idea to wait for 15 years? Means payment stops in 2015 and you get the payment in 2030 once you die. So what is the problem in that? That's fine. The purpose is, what is the basic purpose of taking an insurance policy? You need financial protection. You want to support your family. Suppose even if the earning member dies, the person who was living people, means the person who was surviving, they are going to get the money, the family dependents. So what is the problem? The basic purpose is solved. They are getting the money at the end of at the time of death of the policy holder. What is the problem then? The insurance is serving its purpose, isn't it? And what's the problem? There is no use with that money after these long time. Rezi says that, okay, anyone else has another answer? Or should I repeat my question? Did everyone get the question? Manu Murali is not there in today's class. Monachin George is also not there. Sanubar, Sahel, Muhammad, Akshita, Rinin. What is your answer to this question? See, the basic purpose of taking the insurance policy is financial coverage. Like if a person dies, then how his family survive if the earning member dies. So you die in 2000, your policy premium ceases in 2015 and you die in 2030. Then what is the problem? After 15 days, after 15 years, they are getting the money. The head of the family took the policy to protect his family after his death. So that is happening, Rezi. That purpose is being solved. They are getting the money. The company is not saying that no, we will not pay you. They are paying the money. Then what is the problem? Why do we need to not take such a policy? Family need to pay the premium. No, Nirinin. Payment premium ceases at the end of the policy. Suppose it is for 5 years, the premium will stop at the end of 5 years. If it's 10 years, it will stop. 15, again it will stop. What is the problem then? The policy is good enough. It is serving the purpose. Financial help to the family at the time of death of the earning member. So that purpose is being solved. Then why do we just ignore such a policy? Why should we? It's good enough. The advantage of term insurance is that the premium is pretty low in this. So it's a good policy. Why do we need to overlook it? Tanubar, Seher, Muhammad, Akshita. Any answers you people have? Any answer anybody has to this question? Why should this policy be discarded or not taken or not given preference? No, really. The insurance company will pay them immediately. Once the person dies, after the completion of the formalities, they will get the amount. They will get the amount. That is not a problem. Then why should we not go for such a policy? What is the problem in that? That is my question. Why should this policy be ignored? Actually, the problem is, suppose you take the policy for, now I am giving the answer, everybody please follow carefully. Suppose you take the policy for, the monthly premium that you are paying is 500 rupees. The policy is for 10 years and you die after the period of the policy, means the premium stops at in 2015 and you are dying in 2030. So after 15 years the family members are going to get the premium, the amount of the policy, and the amount which we are getting is the sum which you have insured. Suppose you take the policy for 10 lakh rupees, so they are going to get 10 lakh only. Okay, so what is the problem with this 10 lakh? This 10 lakh has a problem. What is it? That this is the amount which you are getting at the end of 15 years. Now the value of this 10 lakh will not be as much as it would have been at the end of 2015. Because of the inflation and fluctuations in the exchange rate, this 10 lakh will hold lesser value. Okay. If you plan that I'm going to buy a house once I'll get the insurance money, your purpose will not be solved, because when you decided to buy the house, it was for 10 lakhs, but now it is for 20 lakhs. So this, yes, the value of the money goes on decreasing. So in that case, this purpose, the very purpose of financial security will not be solved. Okay, they will have at least something to survive, their family members, but not really in like ample of it. Everybody understood this? Sanubar, Seher, Muhammad, Akshita, Rinin, everybody get this? Seher, Akshita, Muhammad. Okay. So this was the problem with term insurance. That is why endowment policy came into play. Endowment policy is the one in which you get the money either at the death of the person or at the expiry of the period of the policy, whichever occurs earlier. Out of the two, whichever occurs earlier. Okay. Then money back life insurance policy. What is this? This policy offers the payment of partial survival benefits as is determined in the insurance contract while the insured is still alive. In case the insured dies during the period of the policy, the beneficiary gets the full sum insured without the deduction of the money back amount given so far. Means, what is the basic purpose of this policy? It offers the payment of partial survival benefits. Means you get money back in this type of a policy. The terms are decided beforehand as it is decided in the insurance contract, and in case the insured dies, then the beneficiary will get the full sum. Okay. Means your whatever premium has not been paid by you, that will not be deducted. You will be paid everything, the full sum insured. Did you get it? Suppose you take the policy for 10 years, okay, and there is the option of getting some amount of it back at the end of 3 years. So you are surviving during that period. You are getting it. You are getting your amount back. And in case the person dies at the end of 7th year, then it does not mean that the payment made for that 3 years will be deducted by the insurance company. They are going to give back the full amount. Now next is a group life insurance. Yes, it's a money back policy basis. So group life insurance is generally taken by the employers for their employees. Whether it's a school, it's a hospital, or it's a factory, industry, office, anywhere, you will find this type of insurance. And because the employer gets deduction also under this policy, so employers normally prefer this policy these days. So when a group of people have been named under a single life insurance policy, it is popular for an employer or a company to add employees under the same policy. So each member has a group of the group has the certificate as legal evidence of insurance. All of you might be having this type of policy in your office, isn't it? Who all has this policy? Anybody? Anybody is covered under group life insurance? No one. Okay. For this, what do the companies do? They have a card, like Oriental Life Insurance or some other company. They offer a card to their employees, and this card, whenever you go to hospital, you have to show this card to your to the hospital people. They are going to help you out. Okay, your payments will be met out of this group life insurance. And in corporate companies, there are two things. One is they have a normal insurance policy. Suppose the value of insurance policy is 4 lakh. Family health policy, FHPL, Family Health Planning Limited. So they have a policy of 4 lakh. Suppose somebody, and this policy is just for the family. Family means husband, wife and children. So suppose 4 lakh policy you have, and you admit your wife in the hospital, and the expense comes to 5 lakh. Then what will happen? Your policy is only covering 4 lakhs and your expense is 5 lakhs. Then what about this 1 lakh? From where this 1 lakh will come? Anyone has any idea? There is a term called corporate buffer. Okay, there is a term called corporate buffer. What happens is it provides you with the same amount as your insurance policy. Suppose the policy is for 4 lakh, so corporate buffer will also offer you 4 lakh rupees. You will be given an additional insurance coverage of 4 lakh. So your 1 lakh extra outstanding will be met out of this, and 3 lakhs will remain as it is. Okay, that's called corporate buffer. This is prevalent in corporate world today. This type of insurance. Everybody got that? Everybody understood? Seher Tanubir Muhammad Rinan. Why do I have to ask every time? Answers should come from you directly. Seher and Sanubar, did you understand? Corporate buffer? Okay. Now the last type is ULIP, that is Unit Linked Insurance Plan. So they offer the insured the double benefit of protection from risk and investment. It's like investment also. You invest in these and you might just get interest. So ULIPs are linked to the market where the insured's money is invested to help earn additional monetary benefit. Means the amount which you are paying as the premium, the insurance company is not keeping that premium. It is investing that amount into market, in shares, stocks, whatever, and whatever interest you are getting or dividend you are getting, that is your additional income. You are investing also in case of any mishap, the insurance company is going to pay to you, and apart from this you are getting interest or dividend also on your investment. Alright, everybody? Clear, everyone? Okay, this is a simple one. Now we go to the main one, the PPT. So life insurance. Now this is a PPT which covers the basics of life insurance. What is life insurance? That you already know. It can be termed as an agreement between the policy owner and the insurer, where the insurer, for a consideration of a sum of money, agrees to reimburse upon the occurrence of the insured individual's death or any other event such as terminal illness, critical illness, or maturity of the policy. Yeah, the health policies are mainly meant to meet out the expense of the hospital. Now, history of life insurance. So this is about just the insurance history. You can just read it once. Hello, can you all hear me now? Okay, Seher can hear. Sanubar, and you just raise your hand, everybody. You have that option of raising hands. Just click on that, I'll understand. Seher can also hear. Muhammad, Rinin, Munachin, Rezi, can you everybody hear me? Munachin can hear. Okay, okay. So it means everybody can hear now. Alright. Rezi has taken break for namaz. Yeah, I read that. Alright. We can just continue. He'll just come and join in. Okay. So, Sanobar, I asked a question. Can you name two insurance companies of Middle East? Can you name them? I asked a simple question. Just name two insurance companies of Middle East. Sanubar, I asked you now. I need the answer. LIC International, Oman Insurance, RAC Insurance and MetLife. Okay. Monachan has also given the answer. Alright. So, it is just like this. It's just about the history of insurance in India. So, this is not needed actually. We can just go to the next. Again, we don't need it. Now, what are the reasons to have a life insurance? Why do we need it? It protects us against present and future. It gives us liquidity. Liquidity is having Alliance, INC and MetLife. Okay. Rinin, what is your answer? Muhammad, answer from you also. So then, tax benefits. What tax benefits are offered? In Middle East, there is no tax on the income. Am I right? Yes, your income is tax free. So you might not be knowing the benefit of having an insurance policy as regarding taxation is goes. Do you all know? Who knows about it? Rinin has answered. Okay, sorry, I just didn't see that. Alright. You know, in a country which has got taxation laws, so in some of the countries, in fact in most of the countries, life insurance premium payment that we make, it is exempted from taxation. You get relaxation. You suppose you pay 10,000 rupees as premium yearly, then that 10,000 is given. Suppose your income tax comes to rupees 40,000. Then that 10,000 will be deducted from that because you are paying it for your life insurance. Contribution to insurance is exempted, life insurance, and this is done by countries to encourage people to invest more and more in life insurance. It has got two benefits. First, people are getting security, financial security, and then government is getting lots of funds in its hand. It can invest that money in for developmental purposes, or it can use it for other purposes as well. Okay, so tax benefits are very important. Liquidity is like, suppose you have a short-term insurance plan. So you can, whenever you are in need of money, you can just sell that insurance policy, you can get money, and even you can mortgage it. If you want to take a loan from the bank, you can mortgage your insurance policy. Okay, clear everybody? Yes, you keep it with the bank as a security and the bank will offer you a loan. That's an asset, having insurance policy. So money when in need to meet expenses on outstanding debts, for example for the education of children, for the marriage or anything like that. So now what are the types of life insurance policies? As we have discussed, term life, endowment, permanent or whole life, money back, and unit linked plans. This is the new one, permanent whole life. Permanent whole life is when you have to, it's not term insurance, means as long as you are surviving, you have to pay the premium. Once you die, your premium ceases and you get the amount from insurance company. But practically no one takes that policy these days. It was a very old concept to take that policy. People now prefer endowment plans. They are most popular in India, endowment plans. So LIC is the government company, okay, that operates in the sector of insurance in India. So this is all about the details. It has got its headquarters in Mumbai. It was established in this year on this date, and the other details, so on and so forth. Just read this. I'll just get my charger. My laptop is getting discharged. Everybody just continue. Read it. Okay, everybody, this is done. Now we go to next. Objectives, pretty similar to that. Spread life insurance widely and in particular to the rural areas, because rural classes are those which are like ignorant of all these things. So to make insurance policy very popular amongst them, the company operates with the objective of spreading awareness. And it helps in maximizing the mobilization of savings amongst people. Mobilization means movement. Suppose you have lots of money and the money is kept idle in the bank or at the home. That is senseless. If you invest it somewhere, you will get more money from that money. So that's a better way, and that is how people think these days. Okay? So this is done. Continue more or less the same. Just read them quickly. Give a just an eye to them. They operate with the purpose of helping people. Their objective is not sheerly profit earning, but public help also, because it's a government sector company. And it also offers employment to large number of people. People who become agents of LIC, they are self-employed people. They get money for their work. They work on a commission basis. Okay? Now the first one. Term life insurance is the one in which payment is made only in the event of death, and it can be for a very long period and for a very short period also. So no refund of premium. Premium is not refunded. Once you die, only then you get the amount. And the premium is low because the death risk is covered. And this is the reason why such type of policies were very popular in earlier times. But now, not now. Now, annual, or what is level term? Now, what is this one? This says that the face or death benefit amount remains constant throughout the policy period. Means there is no variation in the amount of the policy. Suppose on the day of signing the proposal form, you enter 5 lakh as insurance coverage. You will get 5 lakh only. Whether you get it after 30 years or you get it in just a year, your amount will remain the same. Okay? Then premiums may increase when the contract is renewed. There is option of renewal also in some policies. Like suppose you take the plan for 5 years and now your insurance agent comes and convince you that please extend the period of the policy. So you can just get it extended and your premium will also vary. But the face value will remain the same. Means 5 lakh will remain the same. So renewable term insurance, it gives an option to renew the coverage after the term of the policy is over. and premiums are considerably higher. Now, increasing term insurance, this is the one in which your insurance, your premium goes on increasing as your policy progresses. Like for the first 3 years, your premium will be 750 rupees monthly. Then after that, your premium will increase to 1000. Then after that, it will increase to 1500 and so on. But okay, and after a fixed point of time, like after suppose the policy is for 25 years, after maybe 10 years, the premium will become constant. And it takes into account the inflation or any other changing circumstances. And cover also goes on increasing. Now decreasing, premiums remain the same, coverage amount decreases. Suppose you take the policy for the first year, the coverage was 20 lakhs. In the second year, it might just come to 15 lakhs and so on. And this is normally taken for mortgage purposes. Now, convertible term insurance, this is very simple. This is a policy which can be exchanged for a cash value policy within a specific number of years, except the last 2 years. Means if the policy is for 20 years, then within 18 years you can just surrender the policy and get the cash value of it. But in the last 2 years you couldn't get any such benefit. So these are the names of the policies which are offered under the products which are term insurance: Anmol Jeevan, Amulya Jeevan, 2-year temporary assurance policy, the convertible term insurance policy. Okay. Then endowment insurance policy. What is an endowment policy, which we have already discussed? It is a policy in which the periodic premiums are received and a lump sum is received either on the death or on the expiry of the policy, whichever occurs earlier. And they are more of investment. What are the 3 benefits of this? Savings is there. Wealth creation, you are creating your wealth. Your policy is a wealth. It's an asset in your hand. And again, it has got insurance coverage also. So that is all very beneficial. It has got different types: joint life endowment, marriage endowment, educational endowment. These are the names of some of the policies. I have this one, Jeevan Anand. It's a nice one. How many of you have insurance policy? Who has it? An insurance policy? Monachan has. Anyone else? Rezi is also having. That's it. Now, permanent or whole life insurance. It is the one, it remains active throughout the life of the policy holder and the premiums have to be paid every year. Means there is no such thing that it will be paid for 10 years or 5 years. It will go on till your lifetime. And when the policyholder dies, the face value of the policy, known as the death benefit, is paid to the person or persons named in the policy. The one who we call as nominee or the beneficiary, that person gets the amount. This is also a very traditional type of a policy. So the insured receives a fixed sum at periodic intervals during the survival, and full term assured is paid on the death of the policyholder without any deduction. Yes, this is one benefit of the policy. You get a fixed sum at a periodic interval. The policy period is for 20 years. No, the policy period is like endless. You never know when you are going to die. You may die tomorrow and you may die after 30 years also. So the policy is for a very long period, but there is a facility, like if the policy goes on smoothly, then maybe at the end of 6 years, you might get a fixed sum as a additional advantage. So this benefit is there. These are the names of the policy. Now money back, it ensures periodic payments to the policy holders, and in case of survival, the policyholder gets the full sum assured. Okay, and in case of death, the beneficiary gets the full sum assured. So nowadays, new unit-linked insurance plan versions of money-back policies are offered by insurance companies. ULIPs are very popular these days. Okay. So these are some of the names of the policies: Jeevan Samriddhi, Bima Bachat, Jeevan Bharati. Yes, unit link. Yeah, they are ULIPs, unit link insurance plan. Now this is the most popular, especially among the young people, the young lot. People of your age group, my age group, these type of plans are very popular because it helps in getting instant money and more money. Combination of insurance as well as investment. The premium amount is invested in the stock market and the returns better income on the maturity. Better for long-term investment. ULIPs generally provide higher returns as large portion of funds are invested in equities. Okay, and the premium is also pretty high on these plans. There is also option of switching over from one fund to another if it does not seem to be profitable. That's another advantage. And it has emerged as one of the fastest growing insurance. It comes under the purview of IRDA, that is Insurance Regulatory Development Authority. So endowment and Flexi Plus, these are the products. Now what is claim? Claim, it can be of three types. On the maturity, it will be a maturity claim. On the death, it will be a death claim or rider claim. Or if the person survives up to the term of the policy, then that will be, you will get survival benefits. Okay. So what is maturity claim? Simple. It sends maturity claim or discharge from an original policy bond well before maturity date to enable timely settlement. Suppose the policy is expiring in December 2014. So what is good? From now on you should start proceedings. Your agent should start the proceedings of the maturity because it takes some time for the settlement of the claims. So companies will then offer or issue post-dated checks and or make payments through ECS credit on the maturity date. Alright, you might just get a check beforehand, a post-dated check. Fine everyone? In case there is some problem, you can also refer to the grievance cell. Now death claim, this will arise only once the death takes place. So what is it? First, in case of premature death takes place, within the 3 years of taking the policy or after the 3 years of the policy. The rules are different for the first 3 years, and because some people use it as a means of earning profit. So to avoid such things, 3 years of grace period is given. And what is the procedure for claim? You have to intimate to the company and it should be done by the nominee or the near relative. Proof of age, if it's not given already, a proof of death, that has to be given. So doctor certificate means death certificate by the doctor. That's also important. These are simple things which we have to give. Very simple, like we have to give an identity card, a certificate of cremation, an employer certificate if any, hospital treatment details, certified copies of the post-mortem, or FIR if this is due to an accident or unnatural cause. Okay? Nothing to explain much. Here everybody? Should we go forward? Okay. Now last type of claims, that is survival benefits. So survival benefit is the amount received at the end of the insurance policy tenure. It is not payable in all types of policies. but in endowment or money back plan after a lapse of a fixed period, say 4 or 5 years. Okay, survival benefits. If like you survive till the end of the policy, then you are going to get some additional benefits apart from the sum insured. Survival benefit can take different forms under different policies. Just a detail. In case of term insurance, the insured receives only life cover. No amount is payable on the completion of the 10 years. That we already know. We know only the sum insured will be paid. In case of endowment, the policyholder receives an added bonus, profit or guaranteed amount as survival benefit. And in case of a ULIP or a money back policy, the insurance company provides returns at regular intervals. And on maturity of the policyholder receives a predetermined amount along with any guaranteed additions of survival benefit. Okay? This is just data. That's it. Now, we'll go to the next one. Now, this is very simple. What you need to know before you purchase a policy, an insurance policy. What are the things that you need to know? So this is something which you already know. What is whole life insurance? What does it guarantee? It guarantees what are the advantages of it. First, the rate is fixed, means the fixed premium you have to pay. Your coverage amount, that is death benefit, is fixed. You know you are going to get 20 lakhs at the end of the death. The growth of your policy's cash value is guaranteed. That you are not going to get back. And a whole life policy has a great cash value. Even with the fixed coverage aspects of a whole life policy, the policy actually has a cash value. When you pay your premium, your money is appreciating at a predictable rate. The rate is guaranteed in the initial contract, which leads to a guaranteed return at any time you choose to cash in the policy. Means you can get your policy encashed also, but this is not available with every policy. It's available with certain policies only. Now, who all benefits? Everybody. It is perfect for the people who want to simply pay their premium and know they have got the coverage they desire. Simple type, plain. One of the main advantages of it is ability of the young to lock in their preferred rates. This makes whole life options an excellent basic insurance for parents to carry. The policy will continue to be in force along after their children have grown. Okay? And you can take a policy with a very nominal amount also, like 5,000, 8,000, this will help. So this is what is other like combination is one of the most popular options for the new parents to combine a whole life policy with a long-term life insurance policy. So life insurance quotes means the premium rates, they are less for as compared to a hello. The whole life coverage. Okay. This is just like that, something that you have already know. So this you can just read once you get the PPTs and the PDFs from IMTS. Simple. And the class is about to be over. So kindly just give your feedback at the end of the class. Okay? Everybody, do mention your feedback. Monichin, please be on time tomorrow. Tomorrow you have a class. Okay? Everybody. So see you in the next class. Bye. Do take good care of yourselves and just relax. It's a holiday for you tomorrow. Have a great weekend. Enjoy everybody. Okay? And do mention your feedback.